and welcome to the Stockout. I'm Mike Bowden-Distel. I'm the head of Intermodal Solutions at FreightWaves. Hope everyone is doing well, and I hope it's nicer where you are than it is in Dallas right now, where it's a very gloomy and rainy day. I have an extra light to show my face because it's actually so dark here in the middle of the day. But today, the Stockout is the show that we have at FreightWaves. We set aside 26 minutes to go through everything that's happening in the world of consumer packaged goods, CPG. We follow the CPG industry because a lot of the companies that come to us at FreightWaves are either in that industry or are carriers or brokers, serving that industry. The CPG industry makes up about 1/5 of all freight transportation. It's the stuff we buy every day. Every week that we bring through our front door. So I think it's things that people can relate to. And so this show, I'll kind of split up into two parts, talk about the CPG news, and then I'll go through some transportation highlights, which sort of serves as kind of an industry update. But before I do that, I'd like to thank the sponsor for today's show, which is RJW Logistics Group. RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full month after month to many retailers. RJW's programs offer global suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, grow market share, and increase sales. Visit rjw.com to optimize your supply chain today. So a big thanks to RJW Logistics Group, and I'm going to have them on the show next week, and we'll talk a little bit about the market from their perspective, how they can improve the efficiency of CPG supply chain. So looking forward to that conversation. Hope you can join me for that next Monday. With that, let's go into the first topic here, which inventories remain bloated in most sectors, and have a graphic that the research group at FreightWaves put together, and you can see all of these companies that report their inventory. The research team sort of went through all these public filings to get at this. And remember, about a quarter ago was the quarter when Walmart and Target talked about their their inventories being up 35% or 45% above year-ago levels. And a couple of things really stand out to me about this graphic is that whole list of companies, they're all up, year over year. And the companies that had already sort of sounded the alarm in the previous quarter about how their inventories were too high, those being Target and Walmart. Target's inventories are still up 2% quarter over quarter. So since the prior quarter, and Walmart's only down 2%. Quarter over quarter. Walmart did say they got rid of a lot of the seasonal merchandise, and Target had talked about how they've had huge programs in place to get rid of the excess inventory. Sort of took it as kind of a rip the Band-Aid off approach to get rid of a lot of the excess inventories. Kind of amazing then that it was still up quarter over quarter for Target by 2% and still up 36% year over year, despite taking all of those actions. Walmart up, inventory up 25% despite clearing out a lot of that summer merchandise. And so it just sort of speaks to how much time it takes for some of that inventory correction to take place. And across that list of companies, which included not just those big retailers, but a lot of CPG companies, that whole list had inventories that were well above, year-ago levels, sort of well above quarter, the previous quarter levels. And that's sort of a little bit of a departure even from the previous quarter, where the previous quarter often had to sort of interject when people talked about inventories, when they said, well, inventories are really high. And I had to interject and say, well, really, that's for general merchandise. It's for things like what they call hard lines, things like furniture, toys, electronics. But consumables really go back, quarter ago or so, things that you eat, sort of food products, beverages, personal care products, really hadn't seen that increase in inventories. We are seeing that now. There's been a pretty significant change in behavior among consumers just in the past quarter, seeing that in the results of some companies like Tyson Foods. And I'll talk about that a little bit later. Seeing more companies move to private label brands. You're seeing more consumers do their grocery shopping at the big box retailers like a Walmart instead of traditional grocers. It was interesting that Walmart said that most of the share they gained among grocery shoppers, what were shoppers that make over $100,000 a year doing more of their grocery shopping at Walmart. So it's really the concern about inflation, trying to save money right now, sort of cutting across different income brackets. Also have a chart on here from the Logistics Managers Index on the warehousing prices. So this is interesting because for a couple of reasons, still shows warehousing prices well above pre-pandemic levels, but down quite a lot from their high. And in certain parts of the country, it's still very difficult to find warehousing space. Prices are still high, but the fact that this has changed as much as it has from earlier in the year, you had that warehousing prices there, around 90, now it's down to 76, shows that there's not a lot of demand for new, putting products into warehouses that aren't into warehouses already. So it seems like most of the companies are recognizing that they have too much in inventory. They're making changes to, correct, going forward. So I think that has, really big implications for the transportation market, where those inventories need to be right sized, before you're going to see, a strength again in the transportation market. I'll show some graphs a little bit later on that show the truckload market, loosening. So that's really sort of topic number one. Topic number two is the prices of some cuts of meat are actually declining. It's been a while since I've talked about any deflation aside from maybe energy on this show, which energy prices have been down for a number of weeks, but the retail meat prices for some of the higher cuts of beef starting to come down. What this chart shows is live cattle. Now, that's what the meat processors are buying and processing into the packaged meat. But this is kind of interesting, too, where you go back before the pandemic at a fairly high level, pandemic hits, demand falls off a cliff. A big reason for that was that the meat processors did not have the personnel at their facilities to process the meat. So, those small ranchers that had the cattle to sell really didn't do well in the beginning of the pandemic, and these prices have gradually improved. You sort of go back to the left side of that chart. That's a lot of what the Biden administration was relying on when they were talking about how the meat industry was too concentrated. They pointed to retail prices being too high, and they pointed to the amount that the live cattle, ranchers were getting for their live cattle was too low. Margins for the middleman, which is the meat processors. There's 4 companies that dominate the meat processing industry. Their margins were really expanding. The sort of counterpoint was that's because there's only 4 of them. It's a very concentrated industry. There's maybe collusion happening. The counterpoint was those are just market forces. Consumers were willing to buy expensive meat. They had a little bit of discretionary income. The prices for the cattle were low because there was more cattle available than these meat processors were able to process. And now those market forces, seem to be pointing in the direction of the meat processors having, thinner margins. We did see that with Tyson in the last quarter. I thought it was really an illuminating quarter that Tyson just reported. It was, when they reported their shares were down about 8%. And what surprised the market there was that, consumers were trading down in terms of, the quality of the meat. They saw, chicken volume was up, pork and beef were down. And what we're seeing sort of in some of the latest information that's coming out of the CPG industry is it's not just that beef volume is down overall. It's that within the beef category, the more expensive cuts like the steaks, ribeye, tenderloin, those things, the volume is down there, which is actually dragging down prices for those higher cuts of beef. Those higher cuts of beef down about 10% in the past 4 weeks, but some of the cheaper cuts like the ground beef, that's up 7% during the same period. So you're seeing consumers trade down to lower cuts. That makes a lot of sense here. Interesting that Tyson's average price for beef in the last quarter down 1.2%, and that's with volume also declining. So clearly consumers are changing their behavior in terms of what they're willing to buy. Some of the big meat companies have talked about how the private label brands are gaining share from the national brands they're in meat. And I think a lot of the bottlenecks are starting to become alleviated. I guess the meat processors are having a little bit easier time recruiting, retaining workers as they've increased the pay, and maybe the workers are a little bit less scared of COVID, and also the meat processors have done a lot of maybe creative things to get workers into the facilities, things like arranging rides for them, things like arranging childcare on site. They talked a lot about those things during the pandemic, but maybe the biggest thing is just consumers had that cushion from stimulus payments and not traveling and those things, and some of that cushion is going away. So prices are actually down for some cuts of meat at least. The next topic here is consumers are actually starting to turn away a little bit from grocery delivery. And they seem to be doing that because they don't want to pay the fees associated with, with the delivery. This is sort of just one of many, pandemic behaviors and trends that seems to be reversing itself. There was a good, survey that I saw that Winsight Grocery Business was describing. It's actually a pretty good newsletter and publication for food products. They cited consumers really sort of hate these grocery delivery fees. They said 62% of the customers surveyed that delivery fees were the reason they don't use the delivery services, and about 40% surveyed that they'd rather use the next day delivery versus same day. Consumers are willing to pay about $10 on a $100 order. This about 70% would accept it the same day if that was the case. And so consumers seem to like the convenience of grocery, not completely willing to pay for it. Another item from that survey shows a lot of people just really like to look at the produce, particularly the older shoppers, and some of them are starting to pursue price over convenience. So that's just kind of another trend that I think maybe could potentially help CPG, because I do think a lot of things that go into CPG that are included in that category tend to be impulse purchases. When you think of like the snacks, like the things that Mondelez makes, a lot of those things tend to be purchased pretty impulsively. The next topic here is the Surface Transportation Board seeks assurance on rail's ability to handle the upcoming harvest, and have a sonar chart on this. And this is what the Surface Transportation Board, this is the independent organization that regulates the railroads, this is what they're concerned about. So you look at the right part of that chart. So this is a seasonality chart. 2022 is in white, 2021 is in green, 2020 is in blue. You have this big surge towards the end of the year. And right now, the grain carloads in the U.S. this is a weekly number, about 21,000. That's likely to climb, like it has the past couple of years, between 25,000 and 28,000. Surface Transportation Board, not convinced the railroads are going to be able to meet those expectations. They sent a letter to all Class 1 rails asking how the rails can provide information on how they expect to meet that demand. They also helped organize the National Grain Car Council with representatives from the Class 1 rails, short lines, rail car providers. A lot of those rail cars are leased, and grain shippers. They're all going to meet this week. And this comes at a time when the railroads are just really under a lot of pressure for all the service failures. The Surface Transportation Board had to issue an emergency order against the Union Pacific. This is the first time the STB has done this in about 10 years, and that was to get animal feed to the chicken plants. Basically, the shipper there was saying, well, we're going to have to euthanize millions of chickens if they didn't get the feed. So, the railroads coming under more fire for, service issues. It seems to be an issue that is getting more attention throughout, the country and sort of in the public conscious as well. You've seen a lot of this from politicians, where it seemed like the politicians that used to care about rail service were from the coal states or from the big, agriculture states. And now it seems like it's a wide, coalition that's bipartisan, that's very concerned about rail, service issues. And the Surface Transportation Board, whether you like or dislike the current iteration, seems to be, on what side of the shipper carrier divide that you're on. Clearly, this iteration, is really believes that the railroads have maybe cut into the bone when they, reduce the workforces as much as they have, and seem to blame the precision scheduled railroading, sort of rightly or wrongly, for a lot of these service issues. And you do get the impression that the Surface Transportation Board is going to do more to regulate the railroads in terms of service and price than they have so far. Which so far it's been a lot of listening to shippers complain at hearings and demand more data. There's always now a lot more rail service data available on Surface Transportation Board website. Actually, some of it's pretty illuminating in terms of delayed days. But you feel like the Surface Transportation Board is going to go further than that. So that's something that we're watching that has a big impact on the CPG supply chains, at least in food. And I'll go through a couple more transportation topics, but also wanted to just take a moment to, again, thank RJW Logistics Group for sponsoring this show. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently achieves over 98% on time and in full to ensure a stronger shelf presence, increased in stocks, retailer compliance, and overall retail supply chain improvement. Visit rjw.com and speak with a retail logistics expert about the advantages of RJW's program to make the best of your decision. So we're going to learn more about that next week when have RJW on the show. I believe that's the topic that they wanted to talk about, was the prepaid versus collect freight management for delivery into retail. Not an topic that I'm an expert in, so happy to learn something and when we visit with them. I have a chart in here that I think is really important. I did show it last week, but on the national freight spot rates, and compare that to contract rates. And this was the data that Craig Fuller, our CEO and founder, was talking about on Bloomberg the other day. I think it was Friday that he talked about this, and I'm not going to go over all that he said, but this is really kind of the striking chart that I think CPG shippers are going to want to pay close attention to, where you see the spot rates in white, how much those have just completely fallen off a cliff. Normal conditions are kind of on the left, where the spot rates are higher than the contract rates. And if you can't get something covered in the contract rates, it sort of falls to the spot rate. Unusual for the spot rates to be this far below contract rates in green and be this far below them for this long. But you do see in green recently pretty significant, maybe very significant decline in contract rates. Beginning in June, they were about $3. They're down about a quarter, 25 cents from that to 276. Seem to that downward slope has intensified of late. A lot of that spread has to do with the fact that most contracts roll over in the beginning part of the year. So I'd expect those lines to maybe cross again in the beginning of next year. I think they are going to get closer as the year progresses, but you'll really see a big difference next year when shippers look to renegotiate those contracts downward. And are going to use the spot rates, assuming the spot rates are still low, use that as a guide for what rates is the market really, going to bear when it comes to contract rates. Still, I think there's a little bit of trepidation on the part of some of these big shippers that they don't want to be too aggressive too soon because they want to have that capacity available. I mean, it is a risky, proposition to be too aggressive on rates because it could go the other way, given how volatile the market has been of lately. Most shippers that have tried to predict what's happening next in the freight market have kind of been burned here. Next topic here is the intermodal savings rate has declined rather dramatically. I have a chart on this which shows showing the intermodal savings rate. So what that means is taking the truckload rate, including fuel, and taking the difference between that and the intermodal contract rate, including fuel. So intermodal has that fuel advantage, where it's about half the fuel surcharge, so including fuel, and we're just looking at origin destination pairs with the same 3-digit zip code, and so you'd have a very comparable route there. In a lot of cases, it's the same shipper that's moving both dry van and intermodal in the same origin destination pairs, where the difference is how time sensitive are these are these products? How much is there in inventory? But so basically, it's declined. The overall savings rate associated with intermodal contracts is now about 12% based on the data that we're seeing. And what's maybe even more interesting is that white line, which just shows those lanes that are longer than 1,200 miles. And so 1,200 miles, the lanes are longer than that. That would be your LA to Chicago, your LA to Dallas, your LA to Atlanta. So those lanes that really typically are not very competitive with truckload, those are getting more competitive with truckload. Where middle of last year it was 25 to 30% savings. Now we're showing it's about 17% savings. And then when you look at just the local East market, in a lot of cases, shippers can save money by using the highway rather than intermodal. One of the stats that's really stood out to me from the last earnings season was Hub Group, the domestic intermodal company, which actually just announced an acquisition this morning. They said in the second quarter that their local East volume, intermodal volume, was down 14%. And that it was more competitive with the spot rates on the highway. And so would be lanes like Chicago to Atlanta, maybe Chicago to the New York area. Let's call it Elizabeth, New Jersey. That's anywhere from that's about 700 miles and 900 miles respectively. Those lanes, very competitive with truckload. The spot rates have fallen everywhere. They've been sort of particularly weak in some of those lanes that can get them into a market that's very robust. So a lot of intermodal volume has been lost there. Of course, service plays a big role there too. The service has not been great, although I think it's probably better than it was a year ago, which was maybe the nadir of rail service. So still a lot of things that shippers have to be concerned about if they're using rail intermodal. The next topic here is the union leaders dissatisfied with the Presidential Emergency Board recommendations. So this was finally did get a response from the union leaders after the Presidential Emergency Board issued regulations. So if you haven't been following this, there's a possibility of a major rail strike on September 16th, which is approaching pretty quickly. That could impact 145,000 workers, would shut down the whole rail industry. I think it's unlikely that if there is a strike, that Congress would not order them back to work very quickly. I think the likelihood is they would get ordered back to work very quickly. And using the recommendations of this Presidential Emergency Board, which just posted a 145-page report last week. And really, they struck a balance between what the unions wanted, which was a 31% raise over 5 years, and what the railroads proposed, which was a 17%. They said, okay, let's split the difference at 22%. And the workers would get an extra day off, and the benefits would maybe be a little bit in the favor of the carriers. On balance, it would be the largest wage increase in 47 years. Of course, inflation is the highest it's been in 40, so that seems reasonable. And this is probably the only time I can remember that the railroads have had trouble recruiting and retaining workers. After past volume downturns, they've had no problem getting those workers back to work because they pay more than what they were doing in the interim. That hasn't happened this year. I think the morale, being at a low level, following the cost cutting and precision scheduled railroading, has really had a big impact on railroads' ability to recruit and retain workers. Workers also complaining about less time at home, more time in places that are pretty remote. In some cases, they've complained about having to pay their own travel and things like that. So union leaders pretty dissatisfied, and that may have just been posturing as they continue to negotiate here and drag this out to the 11th hour. But it could also mean that the unions are planning to strike, and Congress is going to have to order them back to work, and maybe that could be disruptive for a period of time in September. I think most people hope that's not true, and that they can come to some resolution. Would not help supply chains, which a lot of CPG companies still are struggling with. I mean, for all that I talk about higher inventory levels, that's not true for every ingredient, and there's plenty of ingredients that can sort of create choke points. We've heard that from a lot of the snacking companies like Mondelez, or even a lot of the cereal companies, General Mills, talking about how at times they have been short on a certain ingredient, have to run their working capital a little bit higher to have a little bit of extra stock in certain of those ingredients. So that's something to be watchful of. I'll keep you updated on freightwaves.com. For anyone who's not subscribed to the newsletter, go to freightwaves.com/the stock out. You can sign up for my newsletter right there under newsletters. It's the first one. Feel free also to sign up for all the others. I think they're all really good. And check back with freightwaves.com daily and every morning at 8 o'clock Central Time for FreightWaves Now. So with that, hope everyone has a great day.